Hi, I'm Jeff McLean, a wealth advisor with Wells Fargo Private Bank. As the presenting sponsor for today's event, we're grateful for the opportunity that we have to show our commitment to the Silicon Slopes community, where we spend so much of our time advising entrepreneurs, founders, and executives. Feel free as you watch today to find me and connect with me on LinkedIn, and we look forward to starting a conversation with you.
Welcome to the Silicon Slopes Breakfast. Today we are joined by Kent Madsen, who is the co-founder and managing director of Epic Ventures. How are you?
Great. Appreciate the invite.
This is a fun one for me. We've known each other for 12 years now, and I got to know you when I was an intern at University Growth Fund, and I remember thinking, you were doing a lot of complex math in your head. You got that background. I'm like, oh, there's no future for me in this
Adding,
industry.
subtracting?
Yeah, it was like everybody else had a spreadsheet out trying to figure something out, and you just did it in your head. And you were always just so nice to give your time to the students and mentor us.
Yeah.
But thanks for being here. So tell us real quick, for those that don't know, what is Epic Ventures? You've been there about 20 years, right?
Yeah. Started in '97, early stage, sort of Series A. Sometimes we do seed deals and sometimes B deals, but focus on Series A. General technology, we do focus on a few verticals, but we do change those over times too. So,
what prompts those changes?
Ebbs and flows in the market. So, I mean, some funds will focus on a specific vertical, like, it used to be hot long ago, B2C or business to consumer, and then a lot of funds switched to B2B, and then it was a fund that was just telecom or just nano, and our belief is that model doesn't work. It may work for a cycle or two, but it's a moving target. There were clean tech funds. There was once a Java fund. They'd only do deals that were Java software. So we try and stay generalist. We do have some ways and some things we do to try and identify the next waves and try and build up expertise in those and be dynamic. So. Gotcha.
All right, so a lot's changed, obviously, in those 20 years. One with the local ecosystem and then, nationally. What are some of the surprises over the last 20 years that you might not have anticipated as a venture
COVID.
investor? There's a big one.
The black swan events are the obvious ones. I started in '97. In '97, it was sort of a bubble, and it was easy. Everything you put money in was going well, but then we had the internet sort of stock market blow up, and with the NASDAQ lost 50%, and I don't know how many in the audience remember that, but that really wiped out the funds. You invest all your money in private companies, and then the economy gets wiped out. And your money's already invested, so you got to really cut costs and really figure out how to things. And then right after that, you had 9/11. So, there's been some blows, and the unexpected ones are hard for everyone's business and everyone's life. And so you got to adapt and change with that. So I don't know if that's actually where you were going for, and sort of some surprises. But the market's evolved. I think all sides are more intelligent, more intuitive, the entrepreneurs, the investors, the financiers, and it's just gotten more and more sophisticated over time, as any industry does. And so I think there's been a lot of incremental, but also, subtle and momentous changes in there too. So.
Yeah, eventually, the information is going to be so pure, and there will have to be some intuition, right? Because it used to be quite a burden to get the data, and you're sharing spreadsheets all over the place. Everything's so much easier now, it seems like.
Well, yeah, and just in the knowledge of both sides, and entrepreneurs, what is stock and participating preferred, and what's normal with the option pool, and what's a normal vesting schedule, and all that sort of stuff. So everyone's just more educated. There's also more opportunities to get capital. You can raise it online. You can do them. Sort of the incubators and all those things. So there's a lot of nuances out there and a lot of opportunity, which I think is better for the customer, being the entrepreneur, to find out which works for them better and who they want to work with. So. Yeah,
the a la carte menu is a lot bigger than it used to be, and that's good. So you guys do early stage. What is your guys' process as you hear pitches, you work with the entrepreneurs? How do you guys process that through with your team?
Several ways. We have a lot of interns, which help. So generally, the deals will come through someone individually or blindly on the website, but blindly on the website's relatively rare. It's usually one of our associates or analysts or, I guess anyone in our firm that knows someone that gets an introduction. And frankly, that's the best way to get in too. If it's purely blind over the internet, sometimes you don't get around. You're so busy, you don't actually go to that, link and go check all those blind submissions. So by far the majority gets in there. And then generally what will happen is, it will pique someone's interest, and there are areas and focuses and verticals that we're interested in, so that helps sometimes, and sometimes that's random luck. But other times they know our fund and what we're looking for. And then the other thing is just sometimes it's just an entrepreneur that we know, or a person that hasn't necessarily been an entrepreneur yet, but we know them through our networks, or someone else knows them, and we just sit down and talk with them. And it's sometimes less about the company. So that's the initial process, but we see north of 3,000 a year. We see more than 10 business plans a business day, so we're seeing a lot. And the best way is just to start to get that intro. And then we'll behind our scenes meet, chat, talk about it, debate it, and you'll usually meet with one person at first, one-on-one, and then we go from there.
Gotcha. And do you have a veto if you don't like a deal? Is it
on
majority
our firm
rules?
it's unanimous.
Unanimous.
Yeah, and it's technically Nick and I as the co-managing partners, but we do have 3 other managing directors, and they definitely have voice and say, and it's not like, even though they don't have an official vote, they do have a de facto vote. But we generally will all have to agree.
Gotcha. And so from start to finish, what's kind of the average time that an entrepreneur would get to know you guys and then a deal happens or a no happens?
It's a great question. Sometimes very fast, and sometimes it's just a right marriage, right person, right company, right idea, and right timing and everything, and we can move really fast. And we can take a pitch and commit in 2 or 3 weeks, and maybe even fund in 4 weeks. That's not normal. I'd say the normal process is more like 3 months. We do a lot of due diligence, and as part of our due diligence, we'll talk to a lot of companies that we know as well, and have them talk with the CEOs and the companies and all that. So that, and hopefully what we're doing is actually bringing customers to the startup as well. So it's not a waste of time from the startup CEO to go meet them and all that. So we do a lot of that. So I would say normally 3-4 months, that's the process. But there are some too that we track for a year or so. We meet very early. We talk to them. We like to get the idea and say, yeah, let's keep chatting and tracking them. So some are a year. I would say on average it's sort of a 4-month process, maybe 5 months process.
What's your favorite part of the process? Because I assume in the early days you had to kind of do everything. And now you've got a support team and these interns. What's your favorite part and what's the least favorite part?
We still do anything. We're pretty flat. We're all pretty flat. I mean, we do help. Some of the interns and analysts will help them set up some calls and do due diligence calls and things like that. But at the end of the day, when we're talking about a lot of the due diligence, I want to do it personally. I want to hear the feedback, and it's a dynamic conversation. I want to be able to ask my questions and things like that. So it is a mix. The funnest part is, sort of proactively defining an area that we're really interested in, and then starting to see some fun, cool companies in that space. That's one of it. So we do a lot in storage. So for a while, we're really interested in something called magnetic RAM. So MRAM, and it could replace SRAM and DRAM and flash. Very, very interesting. And we literally been working on this and spent, honestly, 2 years at this space. And then we found a great company, and so that was really fun, exciting, rewarding. But also just a very early startup process with the company, seeing them get traction, trying to help build the team, try and bring in some customers, some entrepreneurs. That's very fun. And then the exits are always very fun. So it's the 8 years before, in between. It's still fun, but I'd say the funnest is just the start, the passion, the exciting when it's 4, 10 people and it grows to 30 people. When it's going from 60 or 100 to 200, it's different issues and problems.
Yeah.
So.
And you're still going to be involved in those because you have board seats and your friends.
Yeah,
That's a lot of them,
definitely.
So.
We're still involved. Your role, I think, shifts, and again, more towards maybe a biz dev role.
Yeah. What's been the easiest yes you've ever given to fund a startup?
Good question. I honestly, probably Mosey with Josh Coates. And the irony is again, he came in with Mosey and said, we're going to do free internet online backup. And there had been dozens and dozens of companies that have tried to do that. Driveway was one of them, X-Drive was another one of them, raised hundreds of millions, and they all blew up. So it is ironic, and it was funny that it was such an easy yes, and it was really just how well he thought about it, the new shift in model, how to make money, the costs. And it literally was, and this is rare, it literally was one of these, we sat down, we had lunch, and at the end of the lunch, we had all agreed the terms and the valuation. And as part of that process too, again, free online backup, we brought in Drew Majors, who was a former CTO of Novell at the time, to come in with help the technology side, and then we brought in Tim Draper, because for those who don't know Tim Draper was the first money in Hotmail, so it was sort of free email, and then he was the first money in Skype, so it was free telephony, free phone calls, and we thought with he and his branding, we'd say now we got free backup. So that would definitely be one of the easiest ones. Now, ironically, the next one we did with Josh was Instructure, which ended up being really great, obviously. And every university that we know of is using Canvas. But we didn't like the education space. So that one was a little bit of a struggle. We had a great, and at the time, frankly, Josh was not CEO of Instructure, but we were working with him. So, anyway, just ironic.
Those ones are always a little bit more fun, I'd imagine, the easy yeses where it just feels right.
Yeah.
All right, so people kind of associate venture capitalists with that they have a bunch of money, that they decide who to give it to and who not to, which is true, and but that doesn't come without a lot of heartache, heartburn, and sacrifice. So you also have to raise money, right?
Yes.
What's that process like?
Probably similar to the process all the entrepreneurs are going through. It's funny. It's a painful process at one level. Initially, so we do the same thing you do. We go out, we get introductions to institutions or people that might be interested in this space. We, sort of correlate our pitch and try and explain what we're doing and our vision. But I personally, the first meetings I enjoy. I like meeting people, I like talking to them, I like talking about what we're doing, what's different, what we're seeing, and if that makes sense, then let's try and do this. And it's more, I'd say philosophical or, in theory, just having those conversations is fun. The drudgery, and this is probably true with the entrepreneurs, is you've had that first meeting, there's a good connection, you think there's a fit. Now you got to do all the hard due diligence work in between. And that can take 2 months and 3 months. And these institutions, they've got checklists that just go forever. And then they often have to go to their boards, and that's the part I dislike. But the first meeting, just chatting with people, and again, we feel bad. We feel bad when we turn down an entrepreneur, and honestly, truly honestly, a lot of times we're like, this isn't a fit for us, but we honestly wish the best. And prove us wrong, like Josh James, proved us wrong a million times, And honestly, we love it. I mean, it's great. So just because we turn you down, don't take it personally. And because we do that, we see the other side. We don't take it personally when someone doesn't want to invest in us. We get there's different goals, there's different objectives. Not everyone's going to be a fit. So, it's a good conversation, but it takes us a long time to raise money too. It's not an easy process.
So then you raise your fund, all that money just isn't in the account, right?
Yeah, good point. No, people will commit. So if you raise $100 million, everyone will commit to $100 million, and then we will generally draw it down over time. And usually 10%, usually draw about 10% down. Every 6-8 months or so in the first 5 years, maybe a little faster than that. But yeah, and then we draw it down over time, invest it, and start investing, giving our investors back their returns. So normally, we will start returning capital and investments to our LPs before they have invested all their money. In fact, that always happens. So,
which is good.
Yeah, it is good. No, normally an LP will never have more than 80% of their commitment out at any one time because we've started to return capital before we've called it all. So.
And getting into the weeds here a little bit, but when
Yes.
you return capital, That could be in the form of, cash or stock options or just
Or
the
stock, yeah.
Yeah,
Or
stock.
equity, yeah.
How does that usually go? Is it cash or is it stock?
Almost always we do cash because our LPs want that. There
Okay.
are some LPs that when you cash out, they don't want the tax consequence, so they ask for the stock.
Gotcha.
99% of our guys want cash.
Cool.
And gals.
And that's what shows up on the PowerPoint that you go to the next
Yeah.
fundraising round. Of,
Yeah.
Here's what we did. All right, so a lot's changed and is changing. This has been a cataclysmic year in a lot of ways, and anytime that happens, all sorts of cool stuff get born out of that. But for you guys at Epic, and then the industry as a whole, what do you think the next 5 years looks like as investments? What's going to be the soup du jour?
Honestly, good question. I mean, we're super excited about a lot of levels. The economy has, the last, I'd say, 10 years has been unbelievable for investments and exits and liquidities. Just in 2019, we had our companies that sold in aggregate, the value was over $2 billion. Last year it was over $2.5 billion. This year we think it's going to be north of the $2.5 billion again, which is stunning. I mean, it's really stunning. That's got to slow down. And we feel like we've been through that a couple times, so we have some ideas and some ways and some things to do to, when it does start slowing down, we can help our companies and plan for it. But I don't think it's slowing down for at least another year or two. So that's that side. I think we're very interesting. What's going on in the SPAC world, and I think what Carta X is going to do, and all these new ways of getting public besides the traditional, is very interesting, exciting. But we're seeing a lot of really, really exciting deals and ideas and trying to focus on new areas. I mean, we do a lot of SaaS. Everyone does a lot of SaaS. But I think there's a fundamental shift in sort of deep, hardcore technologies that are coming in a lot of areas, in a lot of spaces. And, the sort of the first version of the web, it was like a lot of just marketing ideas. We want to sell umbrellas. We want to sell books. Those companies went a long, long ways. And then you had to shift back to more hardcore technologies in terms of nanotechnologies and telecom and storage. And then you had Web 2.0 and social. And then again, those were a lot of less deep technologies, frankly. Now we're shifting back to AI and some hardcore technologies. And as you know, we talked about, we're in SpaceX, some of the technologies and things that are going there, really, really hardcore, deep stuff. And so we're still going to do some SaaS and software and all that, but I do think there's a fundamental shift now going back towards more of the, hardcore PhDs, research type stuff. And those are fun. Those are exciting.
Yeah, fun for you because I'll read this. I pulled it from your website. Developed mathematical and computational models to optimize vehicle aerodynamics and thermodynamic properties.
Yes, very fun.
So investing in SpaceX for you is a lot different than just a business bro, right? Because you understood.
Well, we did spend time on it, and that is something that is, I think, a little different. It always surprises me, honestly, how many VC funds are out there, they don't have technologists as part of their team. It's really kind of stunning because we're investing in tech companies. And that doesn't mean to be a CEO you need to be a technologist or every VC needs to be a technologist. But at some point I think it does help if you do have some VCs that have actually written programs and done modeling and done AI and worked at the root level here. So anyway, it's just funny. But yes, I think we're trying to spend more time in very, very hard. We just did, a quantum dot deal that we've been spending a lot of time in and things like that. And the things we're coming down the pike are just so exciting. So, Elon Musk did the chips in the brain now. I don't know if you guys have seen and gals have seen that work, but it's stunning. I mean, I'll ask you a question and then you can just think about it and the answer will show up on the computer screen and it works. I mean, I don't know why we're ever going to memorize anything again. Sweet talk my wife, I'll access a poem, and then just...
There you go.
Anyway.
That seems like a recipe for disaster, though, with what's in most people's minds.
You got to have to control it.
That can only be one section of the brain. If you're an investor in SpaceX, do you get preferential treatment to go up?
If I pay the full price, yeah, I'm sure.
It's not very
But
preferential.
no. You know, there's what, 10,000 beta customers right now. There's a list of 700,000 to beta cust Starlink. And no, I got no priority.
All right.
And yeah, I got no priority on a Tesla car either, which really bums me out.
Yeah, you guys got to write that into your
Yeah.
agreements there. All right, so you mentioned briefly interns. You guys have like a fairly robust and well built out junior analyst program.
Yes.
How does that work?
You know, it's good. We spend a lot of time on that. And frankly, pre-COVID, it was bigger. We take about 30 interns from the various universities, running through a training program about what we're looking for, and do some lectures about VC and just startups, trying to give everyone a flavor of the whole space. A lot of like what we did at University Venture Fund back in the day when you were there. And then we keep them for a year, activities and golf and et cetera. During COVID, we've ramped that down, that we're doing about 8 interns a semester. And I think we'll ramp it back up. But we used to have a separate building for all the interns to go, and they could work there. They could come into our main office or a separate office, which was closer to some schools. So yeah, we try and give them real world experience, try and help them figure out which companies that we are involved in, and even ones we're not involved in that we think are cool and might fit their sort of career goals, and make introductions and get them a jump.
Yeah. If you're listening or watching and you're at a point in your life where you could be a part of a program like that, that is life-changing and monumentally good. Even if you end up not wanting to be in private equity or venture, you're still going to have a huge leg up in seeing how the world works.
I mean, I hope so. I hope it's just sort of eye-opening. I remember, as you know, I went to school a long time. I went to school for I went to 9 different universities, right? I studied at a lot of schools. And it was funny that every time I went to a new school, my whole world was just opened up on all these new ideas and new things that, you didn't even think about before. And I hope that's what this is seeing a whole bunch of new jobs, a whole bunch of new ideas, a whole bunch of new technologies. When I say jobs, like marketing or sales, or what that really means, and what's exciting and fun, and whether you want to do a tech company or you want to do High West, that's, those types of companies, just opening the eyes about seeing everything that was out there. And I remember the first school I went to as an undergrad, I thought I wanted to do investment banking and thought it sounded fun, but it wasn't until I actually started interviewing and seeing investment banking I really knew what that meant, you know what I mean? Yeah. So, and even in that area that I knew a little bit about, spending time there, I just felt like it was a rich experience. So that's what we're hoping for. Yeah,
and it achieves it. At the very least, the folks that go through your program will know, like, you're going to have to work pretty hard in this life because you can see how competitive it is. And there's a lot of smart people out there doing stuff.
Hopefully, yeah. Hopefully we get a lot of good work, and hopefully we have some fun too. So,
so I anticipate there being a few more funds in Utah.
Yeah.
Whether it's early, mid, or late stage.
Yeah.
And I'd be shocked if that doesn't happen with some of these liquidity events. What's your view on that? Good thing, bad thing? And ultimately, how will you guys react?
I think it's good. There's, in one level, there can almost never be too much capital. Sometimes I think there is, especially if there's new capital and, they make up weird terms and things like that. But that's the extreme. In general, I think more capitals, more opportunities for everyone, more investment, creating more jobs, creating more ideas. So I think it's a good thing. And we institutionally, and this used to be unique, I think it's less unique now, but when I started in '97, a lot of firms would never syndicate deals and work with other funds. It was all like proprietary and sharp elbows, and we want to keep all hoarding it. And and I think it helped get through the internet bubble, Blurstein and 9/11 and all that. But we've always been, we want to syndicate with smart people that we like, more contacts, more doors, more, Rolodex, to use an old term. And it helps everyone around the table and the company. And so we have always syndicated almost every deal we do with people. And so I think it's good. I think there's enough deals and, that they could use more money. So I'm excited, yeah.
Good. All right, a couple of fun questions.
Yeah.
Because I really think your background's great. Favorite entrepreneur?
Oh, I don't know. I love them all. Seriously, I'm so. Anyway, the whole process, and anyone that's going to jump in from a startup and build a company, and it's not just the founders either, it's early employees, it's amazing. I mean, they're just going to jump in, figure it out. No, they don't know a lot. A lot's going to be on. So I love it. I mean, I guess we have worked with a lot of entrepreneurs that we have really liked and had a lot of fun. So I don't really think I have one.
All
You
right.
have to forgive me, you know?
Okay, favorite investor?
Well, oh, you mean other VC fund?
Other than you or your team, favorite investor. And then the next question will be kind of the fund that you want to emulate or you kind of respect the most.
Yeah. Again, a favorite investor is a tough one. You know, it's like everything in the world. Every investor has unique skills and pluses and minuses. I mean, again, doing this for 20, 25 years, I have a lot of friends at a lot of firms that I just like to work with. And it's you know, hey, we're calling up someone, we've done 5 or 6 deals with it. They're friends, we know each other, we hang out. I mean, so a lot of that. So I guess I don't really have a favorite investor. I would say the fund we want to emulate would be more Benchmark, which I think is a very team-oriented you know, system, and everyone gets essentially the same economics, and it's not very tiered, and we're all watching out for each other, and we all get compensated equally, whether it was my company or your company, and it doesn't matter if Nick found a company or Jack or Ryan found a company. I'm spending time, I'm trying to help that company, and I think Benchmark does that well, and it's a very team-oriented and just holistic, fun approach. And we want to be that way with our CEOs and our companies as well, too. So I'd say probably Benchmark. Yeah.
Very good. The other two, you didn't have to be politically correct, but you were.
No.
But
you know me, I'm not usually very politically correct. But
That's true.
This is being recorded.
we've made it through without any bombs or cuss words. All right, last question. So you make an investment, and 5 to 8 years later, if things go good, there's an exit. Let's just use an IPO in this example. What's the process to decide when, how, and ultimately why, right? Like, because I learned at UGF, you know, it's got to have 100 million in revenue. It's not always the case. But how involved are you guys in being like, all right, it's time?
You know, involved, it's a very ongoing conversation, I think, with the CEO, the entrepreneurs, and the whole board in general. To me, I think, personally, the CEO and entrepreneur should have the strongest voice and opinion. They're the ones involved every day. They're seeing what's going on. They know the nuances and what the market's doing and all that. So to me, that's the most important, and they should have the most say. But it's a team decision. You all talk about it, and we all often will explore, you know, opportunities, and you get companies out there, you know, Ryan Westwood. You know, at Simplus, it was sort of an opportunistic, someone showed up and played a great multiple and a higher multiple, and then, you know, I think anyone in that space had ever paid, and part of that was Ryan was able to negotiate and talk with them, so they paid a premium. And so I'd say we probably exited that a little bit earlier, but again, it was the circumstances and largely, you know, if not largely driven by Ryan and the entrepreneur. So some of it is just timing that's unsuspected. You get opportunistic. The more difficult question is when there is an exit and we get equity. You know, in structure, we stayed on the board for 2.5 years, so you get, you know, constant updates. But there are some where, you know, Health Catalyst went public last year, and we weren't on the boards. We didn't get, you know, the information, and so then we're just essentially an outside investor. Now, luckily, we've been working with them 8-10 years. We know the people, we know the pipeline, we know the products, so you still have a good feel. But as time goes to infinity, you become less and less knowledgeable, and that's the struggles. How long do you hold? How long do you liquidate? And we usually liquidate over a year or so. But I'm going to hold SpaceX for 100 years, baby.
There you go.
My daughters are getting that one.
Good. Lucky them. All right, I lied. Last question. So you worked at Ford, right?
Yeah.
So they've got a couple of cool electric vehicles out, and they've got a bunch in the pipeline. But you also mentioned Tesla. If you had to choose one in a year or two, what's it going to be? Do you have any?
Oh, man, I have no idea.
You don't have loyalty to Ford, though, in that you work there.
Well, right now I was going to say I have more loyalty to Elon.
Right. Smart.
because of SpaceX. But no, that's the thing that's so fun about yesterday's IPO, Volta, though. They build this network of charging stations all over the country. And what is it? Isn't GM, which I think is very interesting, they're saying in 2.5 years, they think over 50% of their new cars will be electric cars. Ford's roughly that, Chrysler's roughly that. You got Tesla, you got Toyota, all of them. But just think, where are you going to charge these? There's no charging network. Yeah. You know, so I think that's huge, and that's what our IPO was yesterday. And I think that's going to be a massive, massive opportunity. Now, one way to look at it is every one of our homes is a gas station, and that works unless you drive out a radius of 50 miles. So the opportunity there and the shift, I mean, I don't think the infrastructure is anywhere near where it has to be if all those companies are doing that. So anyway, so that's a very interesting space. We do have Volta, but we're looking at other things that I think are going to change in there as well.
Yeah,
so
very cool. And it's not the first time that problem's existed, you know, for Henry Ford and these other guys. They're looking around, where the hell are gas stations?
Yeah, exactly.
There's a model.
But now it's going to be so dynamic too, because you know it's all going to be cloud-based. So your car is going to know where to go, and it's going to be proactive too. It's going to say, hey, this person's charging is 3 minutes away from full charge. Go there. And anyway, there's a whole statistical optimization too they're trying to do on how long to charge, because a lot of these people want you to go into a convenience store and buy food while you're waiting for charging. Yeah. But if it's too long, you don't get enough volume. Anyway, it's a very interesting problem.
It'll be a ton of fun. I'm a pretty big tree hugger to begin with, but it helps that these cars are way awesome, way fast, and torquey, and just so much fun to drive.
Yeah. I guess the problem is like in Utah, right? It used to be 80% of our electricity was charged by coal fire plants, or you know, and now it's down to 70. So you get an electric car, but if your electricity is produced by coal, right, that doesn't help a lot. But that's changing too. So I know.
Yep, the markets are coming together. Well, this has been fun. Thank you, Kent. Appreciate your time. Know you're busy. You had a couple of phone calls you got to get back to. But thank you for all that you do for the community and all the help you provide to Silicon Slopes.
No, thank you guys. It's good to catch up, and love to, if anyone's got any questions or anything, let us know. We'd love to talk about what we're seeing coming down the pipeline and some of these new technologies, and I think it's as fun and exciting. It sounds kind of corny, but you know, we're living in fun times. It's really fun.
Yep. All right, thank you.
Thank you, man.
Hi, I'm Jeff McClain, a wealth advisor with Wells Fargo Private Bank. As the presenting sponsor for today's event, we're grateful for the opportunity that we have to show our commitment to the Silicon Slopes community, where we spend so much of our time advising entrepreneurs, founders, and executives. We have the depth and the resources, the experience to work with so many here in the community, and we're grateful for the chance to show our support for what's happening here in the Silicon Slopes area. So thanks for coming to today's event. Feel free as you watch today to find me and connect with me on LinkedIn, and we look forward to starting a conversation with you.